Hi, Else here, and we're going to start analyzing the transactions of Green Inc., a merchandiser who buys and sells widgets to retail stores. We'll focus on individual business transactions in order to analyze and record those transactions. Let's start with June 2nd. Green Inc. purchases 280 widgets from DJB Inc. for $2 each, paying cash. Let's start the analysis using our questions. What did the business get? Widgets, which are owned, can be sold in the future for a higher price, and are due to a past transaction, which means that they're an asset. Since you plan to sell the widgets to customers, they are considered inventory, products that are ready for sale. The inventory account is increased when you buy inventory. What did the business give away? Cash, so the cash account will decrease because it's gone and therefore has no future benefit for the business. Let's record this activity into the expanded accounting equation on June 2nd using account names. The cash account would decrease by 280 times $2, which is $560. The inventory account would increase by the same amount, $560. Notice that the other elements, liabilities, equity, revenues, and expenses, are not impacted by the purchase of inventory. We are basically converting cash into inventory, changing one asset into another asset. Next transaction. On June 7th, you sell 190 widgets to Blue Inc. for $5. In addition, on June 7th, you must also record the cost of the inventory you just sold. Key to remember here is that a sale of inventory involves two distinct transactions. The first entry is a sales entry. This entry records the sale of inventory at the selling price of the inventory to the sales revenue account, the 3 S's entry. If we then use the critical and enhancing questions, we can analyze it further. What did the business get? Cash, which is owned, will benefit the business in the future and is due to a past sale. The cash account will increase. What did the business give away? They gave away a good, delivered it in order to generate revenue. Since they finished their job, completed what they had to do as a business, they can record an increase to the sales revenue account. Let's record it in the expanded accounting equation on June 7th using account names. Cash increases by $950, which is 190 widgets times their selling price of $5. The sales revenue account increases by the same amount. What does that sale do to equity? It increases equity because revenues increase profit, which increase retained earnings, which then increase equity. We did the sales entry. We now have to do the cost entry. This entry records the cost of the sale at the cost of the inventory to the cost of goods sold account, the 3 C's entry. If we then use the critical and enhancing questions, we can analyze it further. What did the business get? Actually, I'm not sure they got anything, so it's unclear. Move on to the next question. What did the business give away? They gave away inventory, which now has no future benefit because it's gone due to a past sale. The inventory account therefore decreases. Move on to the enhancing questions. What did the business earn? Nothing, because we are right now doing the cost entry, and you don't earn anything with the cost entry. What did the business use, consume, or incur? They used up their inventory in order to generate revenue, and that means that there is an expense recorded as an increase to the cost of goods sold account. Let's record it in the expanded accounting equation with account names on June 7th. The cost of the inventory was $2 each, so the cost of selling 190 units is 190 times 2, which is $380. Inventory decreased by $380. The cost of goods sold goes up by $380 because you have an expense which is used in order to generate revenue. Wait a minute. We have a negative under assets but a positive under expenses. It appears that the equation does not balance. Recall that expenses on the expanded accounting equation are always entered as positive because expenses are increasing. However, once we flow the expense numbers up into the equation, they become negative, and their impact on profit is negative. The impact on retained earnings is negative, and therefore their impact on equity is negative. Since the impact on equity and assets are both negative, the two sides actually match. Let's recap the basic purchase and sale of inventory. When we buy inventory, we increase inventory because we have an asset that will benefit us when we sell it. We record it at the price we paid for it. When we sell inventory, we have to record two entries. The first is the sale of inventory for the selling price to the sales revenue account, the SSS entry. Keep in mind that this might also impact the cash or accounts receivable account. Then the second entry is the cost of inventory to the cost of goods sold account at the price it cost us to buy the inventory in the first place, the CCC entry. This last entry also decreases the inventory account. It's important to remember that the sale of inventory always includes two entries, the SSS to record the sale of inventory and the CCC to record the cost of inventory. In the next video, we'll continue on with this example.